And we also have a perfect moderator, Krystal. She is a tech M&A and IPO reporter, so a specialist in the IPO part at Reuters. So I would like to welcome her on stage.
Thank you, Elma, for the intro, and thanks everyone for joining us today on the session as we dig into the pricing of an IPO. It's actually a pretty perfect timing to talk about IPO, because as we speak today, the IPO market in the US just reached a new record that we are now in 171 billion in IPO volume this year, which already existed last year's total. And now we're still sitting in mid-June. So apparently the IPO market in the US has been really active, and there are more questions raised about what's the right way to price an IPO. So we'd love to introduce our panel with you guys. Will join us will be Professor Jay Ritter, which is known as the IPO professor from University of Florida, who have decades of experience researching on IPO topics and alternative ways that company can go public. Also, we have a great representation of the investor base, which is Fredrik Cassel, joining us from a prominent early stage European VC firm, Creandum. Thank you for joining us, Jay and Fredrik.
Thank you.
Thanks, happy to be here.
Yeah, so I guess to start, not everyone have experienced the IPO pricing process themselves. Can Jay give us a brief overview what an IPO process looks like, and what are the IPO pricing calls are like for people who are experiencing it?
Typically, a company will contact investment bankers, underwriters, to assist it with going public and advise the company on how to do it, and then price the deal. Typically, there are three goals, motivations for going public. One is to raise capital. The other is to create liquidity so that existing shareholders can cash out if they want, and for the company to be able to raise money in the future if it wants, and also potentially as a currency to make acquisitions. A private company has difficulty getting another company to accept stock in a private company. But if the company is already publicly traded with an obvious market price, issuing shares to acquire another company is a very common thing to do. With the IPO process, the company has to prepare with audited financial statements, meet the regulatory, both governmental and exchange requirements to get ready to sell stock to investors. And then typically there's what's known as a roadshow, which in the last year has been conducted with video calls, but where the company and its underwriters are reaching out to institutional investors and finding out about their willingness to buy and at what price they're willing to buy. And that roadshow is partly a marketing campaign, and partly it's trying to acquire information about the state of demand. And then the company and its underwriter agree on an offer price and number of shares to sell, and the stock starts trading the next day. And usually, although not always, there's a price jump. Might be small, might be large. And this has been the subject of a lot of controversy, and Fredrik and I will be talking about it for the next half hour.
Great, thanks for that overview. And to our audience here, during the session, for any time when you have questions or related comments, feel free to put it in the chat. And to your point, Jay, that as a reporter, part of our job is covering that IPO pricing and listing process. And of course, everyone would love to see the jump when they started trading. And if a stock is trading below its IPO pricing, you will be usually see as a failure. So in your view, who are the key players in deciding the IPO pricing? Is there pressure to intentionally underprice IPO for a jump on the listing day?
Well, most companies would like to see a little bit of a jump, but just as if you're selling something else, if you're selling a car, you don't want to sell it at a price and then see it being resold at a much higher price immediately thereafter. So the seller would like to try and get a high offer price. The underwriter generally would like to get a high offer price as well, and that typically they're getting a commission, an underwriter gross spread, as it's known, the fee that's a percentage of that offer price. But the interests actually are not perfectly aligned, because with the underwriters, if there's excess demand for the shares, they then get to decide, when they're using book building, the way most IPOs are sold, which investors get the shares. And if they've got extra demand, they've got a choice. Do I give shares to investor A, or do I give shares to investor B, who might be a hedge fund who's a really profitable customer of mine? Well, you want to keep your profitable customers happy by giving them underpriced IPOs. And the profitable customers might be willing to overpay on other deals, other trades, so that they're profitable and given priority on the underpriced IPOs. Well, this is where the conflict of interest comes in, where the underwriters are not only getting the direct fees from the issuing company, but they're getting indirect payments from hedge funds and others in return for getting underpriced IPOs. And if these other payments are bigger than the direct fees, this actually creates an incentive to choose a lower offer price by the underwriter, to underprice, to leave money on the table. In practice, this is a real issue where a lot of underwriters intentionally underprice so that they can give underpriced shares to their hedge fund clients.
So you talk about some conflict of interest from underwriters there. I want to bring in Fredrik, who can share some perspectives from an investor side. Fredrik, a lot of your portfolio companies have gone through that process, and you have been sitting on a lot of the IPO pricing calls personally. Was there a push for you to get the company to a fair pricing? What it was like for you during the IPO pricing process as an investor?
So I think I just want to start by making one general comment around what Jay described here. I think it is very odd, isn't it, that there are new shares issued to buyers that are priced after a book building process like Jay described it. And typically the advice from the underwriter would be to get the books covered, 20 or 30 or 50x. That is the advice that you are given as CEO, perhaps, of the business that you're taking public after many years of hard work. And maybe it is actually the one and only IPO that you will ever live through, if you're so fortunate. Whereas your advisors maybe will be doing, many IPOs, as you alluded to, even within a single year with the same counterparties on the buy side. So that is one mechanism for establishing a price that happens, that finalizes most often on the day prior to the first day of public trading. And then in the morning of the first day of trading, there's a different way of establishing the opening price for the stock. And that is done, today, that's done in a very high-tech way, with algorithms actually deciding, matching supply and demand, just like you would like the dynamic to work, and which basically means that there's a perfect match between supply and demand. And if it turns out then that the price pops, that there's a significant uplift in price, that is just simply put a very, very big wealth transfer from the prior owners of the shares to those who just bought the newly printed shares the day before or signed up for them, committed to them. So there is a fundamental and underlying problem in that wealth is sort of transferred from one party to the other here. And that is sort of an effect of the misalignment that Jay pointed to.
Right. And to your point, Fredrik, why do you think banks has been doing such a poor job in predicting the demand?
Well, look, I don't think it is. There could be voices suggesting that it is sort of bad intent, but I think, like we all know, the IPO process has been designed for another time and for another era than we're in today, where technology wasn't prevalent, where actually distribution, actually getting access to these buyers of shares was a significant endeavor, and one that you couldn't take on without at that time, massive sales forces that the banks upheld. And so there was a point in time where actually this intermediate layer created a lot of value when it comes to distribution and access to the money. I think we're today in a world where maybe the IPO process itself hasn't really adapted to the new environment with a lot of technology that just makes it very easy for one thing to make information about your company publicly available and accessible, like has been displayed by the companies that have chosen to go public via direct listing. We'll talk more about that. So that's something that has been, radically changed with technology, but also actually the price discovery has been also a lot improved, and there's been a lot of improvement in that technology by the market makers that sort of open the stocks every morning on the stock exchanges. So I don't think it is necessarily, only bad intent. It is also a lot of legacy that comes from this process being defined by another time and another era.
Let's see the company side of it, because I know, Jay, you have done a pretty good research of the underpricing last year, which hit a record high level in the past 20 years. But on the same time, it seems like most companies are okay or not like furious as you would think they would be about it. What does your research show about that question?
Well, Krystal, as you just mentioned, last year and continuing this year, on average, there's been extreme underpricing of IPOs in the United States on both an equally weighted and a proceeds weighted basis. Last year, the average first day return was over 40%. Now, that doesn't mean every stock jumps up that amount. Some have jumped up more than 100%. Some start trading flat or down. And for some companies, it's difficult for the underwriters to estimate in advance just where the market price is going to wind up. In particular, the strength of retail demand from individual investors can be somewhat unpredictable and sometimes surprises the underwriters, even when they've got a good gauge of what institutions are willing to pay. But as Fredrik was just pointing out, when the stock starts trading in the market the next morning, typically there's a designated market maker that collects buy and sell orders and is able to find the market clearing price. Technology has changed, and it ought to be easier to do that in the book building process with modern technology. He mentioned direct listing. This is a process as an alternative to the traditional book building approach, where about 10 companies in the last couple of years in the US have used a direct listing where they've skipped the underwriting. They've skipped an offer price. Instead, the stock just starts trading where a market maker figures out where demand is equal to supply. In fact, one of Fredrik's portfolio companies, Spotify, was the first company to do this in 2018. The first to do it is always a bit of a pioneer where there's uncertainty. But this has been especially appealing to prominent tech companies where most of the underpricing occurs. With a lot of older, more mature, mundane companies, it's not that difficult to figure out where the market price should be. With some startup tech companies, it's more difficult. And in the process of going public, the underwriters are talking to the issuing company executives, and they're trying to figure out where the price is likely to be trading at. And if they start talking about $20 a share, the founder might be sitting there saying, hey, I own 10 million shares. At $20 a share, I'm going to be worth $200 million. And so they anchor on the numbers that they're hearing. And if the stock starts trading below that, they're going to be disappointed. If the stock starts trading above that, they're going to be happily surprised. And this is why, in many cases, when there's a price jump, the issuing company isn't upset about it. Instead, you've got the CEO, other pre-issue shareholders that had come to expect a certain level of paper wealth. And when they find out that number is higher than they had expected, they're happy. All of us would be happy.
Yeah, that's a good point you made about direct listing. One of the alternatives into IPO, we have been definitely seeing got more popular, especially among prominent tech companies. This year, we have seen the examples of Coinbase and the Roblox, and you especially mentioned the example of Spotify, which is one of the first companies to do it. I remember when I was covering the Spotify direct listing, everyone was trying to figure out, wait for their first trade started. Fredrik, you were in early investor in Spotify. What was the experience like for you when they decided to go for direct listing?
Look, I think it was I can't hide that it was a fantastic experience in many ways. It was a monumental holding and an incredibly important company in so many ways for European tech, other than just the proceeds and the direct listing. So it was, of course, incredibly exciting process. But the direct listing process actually added quite a bit of flavor to it, because it's, and this was spearheaded. I can take zero credit at all for this. This was spearheaded by Barry McCarthy, the CFO of Spotify at the time, previously with Netflix. He put a lot of work into this and architected the whole thing. And I think the one thing that I do take away from the process was the fact that there was actually a lot of advisors and a lot of constituents that were learning as the process evolved. So it was a first of its kind. It actually really felt like a first of its kind when you were slightly on the inside, because there were a lot of things that people learned about the process as it went along. And I think the motivations were probably a little bit different. I think Barry has spoken openly about his desire to break new ground, and also to avoid this wealth transfer that we talked about. And I think Daniel has commented more openly around another aspect, which is the ability to talk openly about the company's plans for the future, and also his desire for the information about those plans to be as accessible to anyone, to be similarly accessible to anyone, whether you were a small private investor or whether you were a very big institution. So I think motivations were a little bit different on these two parties, but I think it's in total the outcome, both for European tech in terms of monumental company going public, but also first of its kind of finding a new path to the public markets was phenomenally exciting.
Yeah, and we have seen other companies following suit of Spotify since its successful direct listing. And Fredrik, you talk about one advantage direct listing has over traditional IPO is the company was able to talk about its future plans, which in traditional IPO, there is very strict disclosure rules around that. And I think it's time also to bring in another alternatives that we have seen gaining popularity in the past year, which is SPAC, Special Purpose Acquisition Company, also known as a blank check company, which is the company that first go public through first without a sustainable, like a substantial asset, but then looking for a target to merge with later, actually has become a really popular ways for European companies to go public in the US. We have seen examples of Kahoot, which is a British car dealer, and a bunch of Israeli tech companies have chosen this route. Maybe Jay, would love to hear your thoughts on why we're seeing the resurgence of SPAC products and how it has emerged into one of the most popular ways for companies to go public as an alternative to IPO in the past year.
About 15 years ago, before the global financial crisis, there were a fair number of SPAC IPOs that then resulted in mergers, although a lot of them were kind of disappointing mergers. The quality of the companies, the operating companies that merged with the SPAC, it wasn't all that good. After the global financial crisis, the SPAC market, which has mainly been a U.S. market to date, was fairly modest, but then starting a little over a year ago, it really took off. Why did it take off? Partly better quality people involved. Partly there were a couple of SPAC mergers that resulted in high returns for investors. DraftKings, an online sports betting company, went public with a SPAC merger and then did very well. Some other high-profile companies did very well after the merger, and investors tend to chase past returns. And that resulted in a real boom. Last year, 2020, 248 SPAC IPOs occurred in the US. The first quarter of this year, 298 occurred, more than quadrupling the pace of the previous year. Although the last couple of months, things have slowed down a lot and a lot of prices have dropped. This is definitely an alternative way for a private operating company to go public. Rather than going public itself, it goes public by merging with a publicly traded SPAC, and the SPAC then changes its ticker symbol, and in return for delivering the cash, becomes the operating company that investors own. But SPACs are also a fairly expensive way of going public. And that has cooled some investor enthusiasm about them. I expect that they'll continue to be there, but I don't think they're going to replace traditional IPOs.
Good to know. And Fredrik, I'm sure some of the portfolio companies you work with probably have gotten inbounds from SPAC sponsors who are looking for targets to merge with. How would you advise those target companies? And what's your thought process as when they think about a traditional IPO versus a SPAC process?
Look, I think in a glass half full scenario and sort of an ideal world where only the companies that are ready for public markets would be potential targets for SPACs, and the same sort of quality standards apply, and the readiness bars are the same. Save for the additional cost of the extra cost that a SPAC path to public listing implies. There's some advantages, including net sort of higher certainty of completion if you're negotiating with one counterparty as a company in terms of going public. Thinking about the earlier discussion that we had here around price discovery, there are also good arguments that process could be made more efficient if you're sort of everyone is around the same table discussing what the appropriate price should be, and everyone can look at the same data at the same time and agree on a price. So I think there's certainly advantages if you look at it from a sort of a glass half full perspective. When it comes to our advice, I think we've tried to stay neutral, and those companies that have had sort of a public listing in sight, we've not necessarily found it more attractive to shortcut that via a SPAC for the reasons that we talked about. So I think it's an interesting new element, and potentially particularly interesting for certain companies. It hasn't been a prime path for any of the companies in our portfolio.
Interesting. Why hasn't it?
Look, I think it's it's a trade-off where the regular path to market be through a direct listing, or permutations thereof, like we've had with Kahoot in Oslo, for instance, or more sort of a general just planning for a regular IPO with the preparations that entail. We just haven't found the let's say the advantages to outweigh the additional cost, and also partly the control of the incoming owners.
I see. And to go back to our topic about IPO pricing, I know we covered a lot in our first 20 minutes and basically walked through some of the IPO alternatives as well. And you guys specifically mentioned some issues with the existing IPO process with the price discovery, shares allocation, and the potential conflict of interest among underwriters as well as the investors. And we also talked about alternatives like direct listing and SPACs, which become increasingly the new toolkits for companies who are looking for a public listing. So what can a traditional IPO learn from those alternatives? Or do you think those alternatives could be pressure the traditional IPO process to make some changes or to improve the process?
I think that with SPACs as an alternative, it's increased the bargaining power of operating companies. Not only could they do a traditional IPO, they could do a dual track. At the same time, they're talking with an underwriter about an IPO. They could also be talking with SPAC investors about possibly merging, and it increases their bargaining power. For one thing, as Fredrik just mentioned, with pricing, in negotiating a merger with a SPAC, the operating company and the SPAC have to negotiate about what the price is going to be. And then typically what happens is a PIPE investor, private investment in public equity, investor is brought in, might be a private equity firm, might be a mutual fund, might be somebody else, where they're going to put in additional cash, buying more shares. And typically they're putting in a lot of money, might be 50 million, might be 100, and they've got a big incentive to do due diligence. And public market shareholders like this because if they see some big institutional investor putting in 50 or 100 million at a given price, they know that that investor has done due diligence, certifying that this is a deal that makes sense at the price that we're talking about. But the disadvantage, that the high cost aspect of a SPAC is the creator of the SPAC, the sponsor, gets a big cut of the action. Now, this cut of the action is negotiable, and that's one other lesson that we might learn. Lots of stuff is negotiable. Certainly with a SPAC merger, lots of the terms are negotiable. You don't want to accept the first offer that comes along. And this is one of the problems with a traditional IPO. By the time that you've done the book building, you're negotiating the offer price with an underwriter, you don't have a lot of bargaining power anymore. You've got a lot of sunk costs, and you put a lot of effort in, and the underwriter can kind of say, take it or leave it. And it's a rare operating company that walks away and says, no, I'm not willing to do it unless the price is a little bit higher.
What about you, Fredrik? One last question from me, then we'll move to some audience Q&A. And you talk about some flaws in the IPO process, and sounds like you are a big fan of direct listing. But a lot of people argue direct listing is not for everyone, though. Do you think some of the flaws you talked about in the IPO process could be fixed?
No, I think, as Jay mentioned, I think we're with the emergence, with the higher prevalence of direct listings and the alternative SPAC path to public markets, I think we're going to see a gradual change of some of the traditional framework surrounding the IPO process. And I wouldn't be surprised if we're embarking on a journey now, 5 to 10 years, where a few things are going to change. So I don't expect things to work exactly like they always have in 5 to 10 years. And I think IPO is going to remain an attractive path to the public markets for some companies, and direct listing is going to remain another attractive path. So I think we'll definitely see more of the latter. But traditional IPOs is going to be it's a well-functioning, well-established path and sort of well-known, and there's going to be a lot of advice pointing in that direction from investment banks and other stakeholders. So I think we're going to see both. But if anything, I would bet on more direct listings, happening in the tech sector, yes, but also outside in the coming years.
Yeah, that's very interesting. And thanks, guys, for sharing your perspectives and also kind of educate our audience on different ways of going public. And we can turn to some specifically questions. And we do got a very specific questions about IPO, which is how would you evaluate some of the millennial brands doing an IPO? I think we're talking about like a new economy and some brands that have been specifically engaged with the young customer. And one example they mentioned is Oatly, which recently did a public IPO in the US. And we got this question asking, is this a strong example of brand loyalty or Impossible Foods, this belief in the new tech? So generally, how would you evaluate some of the millennial brands who are embarking on an IPO process? Fredrik, you are an investor in a lot of internet and consumer brands. And what do you think of those brands? And do you think going public is kind of a new journey for those brands to expand and also increase in scale as it grows in different markets?
Well, thanks for mentioning Oatly. It is sort of on Creandum's anti-portfolio. It's we're from the same country, but we've got no exposure. But very, very happy for that company. I think there are many questions in this question. I certainly think that there is one part of the question that relates to the pricing specifically for these companies, and that's hard. It's very hard to weigh into because I think we're in a very aggressive market, and there's a lot of weight put on future growth and eventual growth of earnings. So I think it's hard to comment on that. But the other part of the question is how much value can you attribute? Is there specific value to be attributed to the companies that have managed to grow big within a younger audience? And for me personally, I feel strongly about those kinds of brands, those kinds of consumer brands. I think consumers and young consumers are becoming more and more conscious about their consumption and where they spend their money and what food they buy. And I think personally that getting inside of the wallets of those consumers is hard, harder than it's been in decades. And for that reason alone, I think there is, you could justify a specific value for those companies that have managed to do that.
I see. And we also got a pretty good follow-up questions about valuation. I think this has been a theme a lot of reporters like me have been covering, is that COVID has definitely become a tailwind for a lot of technology companies. And indeed, people make the argument that maybe it makes it more trickier for some underwriters to price IPO because they did not expect the demand for certain company shares will be that high. So Fredrik, as an investor, how are you evaluating the valuation of companies that have facing this COVID growth, and to assign the valuation and see if that growth is sustainable as the world maybe rolls back to normal?
This is a super relevant question and one that we're dealing with very much on a daily basis today. And I think just like when we entered COVID, there was a lot of uncertainty and there was a lot of change for many companies, big and small. And I think that sort of moving into a post-COVID world is going to also impact a lot of companies. Some of them actually maybe even more dramatically than entering into COVID. And I'm thinking more specifically about sort of the digital services that have enjoyed so much growth when consumers have had excess time to spend on their mobile devices in front of their screens. And when suddenly societies open up, I think it's almost a more discrete jump downwards in demand than some of the same companies experienced going into COVID. So I think there is absolutely reason to be mindful and cautious about that. This all said, we are trying, and I think most investors are trying to look beyond individual trends. I mean, for us, Creandum is an early stage venture firm. The fund invests in companies with a 10-year perspective. So then it is much more important to find out what is the fundamental value and the fundamental underlying growth that this company can achieve over not 1 or 2 or 3 years, but an even longer period of time. So we try as good as we can to filter out the sort of shorter term fluctuations from the signal and bet on those things that we think have pivotal power to change big markets around. And so if you sort of zoom out to that level, it is possible to disregard a few of these fluctuations that we mentioned.
I see. And I would love to close our session with a question about the relationship between SPAC and IPO and direct listings. Do you guys see certain type of industries or companies from certain sectors of the economy that may be fit for each approach, or it's a pretty individual company-based decision? Maybe Jay, you can go first.
Yeah, I think in the last year, there have actually been some pretty strong industry patterns there. Biotech has been almost exclusively traditional IPOs. Direct listings have been embraced by a lot of big, prominent tech companies. And some companies that are too early to otherwise go public have been engaged in SPAC mergers, but that's not the case with all of them. Actually, when you look at all of the companies that have gone public via a SPAC merger, it actually covers companies of many different ages and many different industries. But the big tech companies, direct listings are very attractive. And for biotech, traditional IPOs are very attractive.
Yeah, not much to add there. I think it's the implications and where sort of direct listing trend is heading is of course also interesting. Where in some of the direct listings, literally speaking, if you have an account with Robinhood or another online brokerage, you have more or less the exact same access to those shares. Like your bids are treated as a consumer, even retail investors, they're treated just like the biggest institutions on the planet. And I think there's something incredibly, liberating in that idea. And so just send that off as a final thought on there are elements that we see now that I think is going to be more prominent and maybe more defining for direct listings as we move ahead.
Great. Thanks for sharing your thoughts, Jay and Fredrik, and thanks for the questions from the audience. In today's panel, we covered the IPO pricing process and the traditional flaws with the process and potential conflict of interest, as well as share allocations and how some companies have left money on the table. We also talked about some popular IPO alternatives, including a direct listing and a SPAC process. And it sounds like our panel do believe in the future we may see a hybrid model of ways of companies going public, and the IPO process may improve in its own as well. So as we are gearing up for a summer full of IPOs, hope this session can help our audience to understand what entails in an IPO pricing process. So that concludes our sessions today. Back to you, Ahmad.